And on Thursday, we started June with our third morning win in a row. MBS were up 23 basis points in the morning, 3 winning mornings in a row. Wow, it's almost a miracle anymore. Stocks were also up about 8 points. We got our challenger job cuts this morning, which showed that there were 80,000 job cuts on a 92,000 job cut forecast. ADP Employment came in at 278,000 on a 200,000 forecast. It was 296,000 previously. 208,000 of the 278,000 job gains were in the leisure and hospitality world. Annual pay for job stayers is up 6.5%, which was 6.7% previously. Job changers saw a 12.1% increase versus 13.2% it was before. After a bit of weakness following the first round of data, the second round is leading to a friendly reversal. A slight increase in jobless claims is a small benefit for bonds, but the big miss in labor costs is garnering a little bit more attention this morning. We had 3 Fed speakers yesterday. Meester, ever the contrarian, wants to hike more. The other 2 indicated they're in favor of skipping a month next time to see more data and the impacts of things already done. Philly Fed President Patrick Harker said Fed really should skip, not pause, rate hike in June, meaning that he's not saying that we should not stop tightening, just wait a little bit and see what the data says, which seems to make a lot of sense to me. This comment caused a dramatic shift in the Fed fund futures, which now sees a 75% chance of a pause in June after forecasting a 75% chance of a hike a few days ago. The Fed pauses in June. That should hopefully suck some volatility out of the bond market, which has been elevated since the Fed started tightening last year. The MOVE index is sort of like a VIX for bonds, shows how much volatility has increased, and it's been a lot. While bankruptcies were low in 2021 and very low in 2022, they are meaningfully rising. Through April, U.S. bankruptcies are at their highest level since 2010 in the immediate aftermath of the Great Recession. The rise is the inevitable result of higher interest rates, the failure of some regional banks, rising building occupancy, vacancies, rates, progressively tighter lending standards, and I would also think that being stuck at home, divorces. Reprice risk on the day was moderate. We really didn't see much of anything. Yesterday's economic data made for a bit of back and forth in the bond market, with Fed speakers ultimately riding to the rescue by forwarding the notion of skipping a rate hike in the upcoming meeting. Today was a bit different, with the AM economic data largely coming across in a bond-friendly manner. This is especially true of Q1 labor unit costs, which missed estimates by a wide margin. At the end of the day, we were up 31 basis points. 10-year Treasury was down 3 basis points at 3.61, and stocks gained 41 points. So ending up with the 5.5 at 100.17. It's putting us in the middle of this range, with the floor at 99.845 and a ceiling at the 25-day moving average at 100.306. So we're going to look to tomorrow jobs report to see if we're going to go back down to the 3.4 to 3.46 range on the 10-year, or if we're going to stay up where we are now.